the end of the year, I'd like to move some positions from qualified IRA and Roth accounts to non-qualified individual brokerage. Should I do this now or wait until later in the year? And in light of your previous comments, we're starting to see cracks in the economy. Should I move these positions now or should I wait? What do you think, Shanna?
Well, goodness. Okay, so there's a lot there. Yes, we do talk about that a lot. So I'm in the camp. I believe taxes are going to be higher in the future than what they are today for a couple of reasons. If you look at the debt that our country is in, over $30 trillion, if you look at the reckless way that all administrations have been spending money lately, the deficits that we have, even though this Inflation Reduction Act says that it's going to reduce the deficit, it's just not the case. I mean, you have them coming in and saying that Biden has reduced the deficit. Well, all that was the fall off of all of the COVID relief programs. You've got the Biden administration forgiving student loans and putting a ton of money into the CHIPS program, into the climate change agenda, with solar panels and all of these tax credits, and just spending all kinds of money on everything that they can think of. That's just what they do. So it's going in the wrong direction. We're already at a point where we have to see higher taxes in the future if we're going to try to get our debt under control and get the deficit under control. We need a combination of things. We need a reduction in the size of government. We need a reduction in government spending. We need the government to get out of the private sector and quit trying to be everyone's God. Quit trying to take care of everybody. Just do what the government is supposed to do, which is to provide national defense, infrastructure, the things that the founders of this country knew that government was supposed to do, and get out of all of these other things and just leave it to the private sector. Leave charity to the churches. The churches will do a great job with that. The church always rises to the occasion. So for those reasons, I think that taxes have to be higher in the future than what they are today. Now, the way that you win in a qualified account is an account that qualifies for special tax treatment because the government says so. The government created those accounts through the passage of certain laws, and they control the rules. So that's the other risk to these types of qualified accounts: government regulation and higher taxes later. So the way that you win in a qualified account is to get the money out at the lowest tax bracket. So what you need to do is you need to look at your tax situation and figure out what tax bracket you're in. If you're in the 12% tax bracket, to me, it's almost a no-brainer. Now, you should consult your tax professionals for any other, outlying factors that may impact your situation. But it's almost a no-brainer to get that money out at 12% because I don't think you're going to see an opportunity to do that much into the future. Even if you're in the 22 or 24% bracket, it's still it's a tougher decision. But to think in the future, are you going to see tax rates below 20 to 24%? If you think not, then it makes sense to, number one, not put more money into qualified accounts if you're in that tax bracket. Just pay the taxes now and don't worry about kicking the can down the road to when you, at a time when you won't know what tax rates are going to be, and try to get money out. So I'm glad to see that she's doing that. Should she do it now or should she wait? If you see a downturn in some of your positions, which you may already have that right now, it would be a good time to move them out, because if you're moving the securities out in kind, which you need to check with your brokerage account to see if you can do that. But if you do that, you just move the shares out and you pay taxes on the value of what they are on the day that you move them out. So if you have a position that's down, 20, 30, 40, 50%, and you move it out, you pay taxes on it there. If it's something that you have conviction to hold, if it's a foundational stock or, just something maybe in the tech sector that's beat up, you can move it out. If it's a $10,000 position that's only worth $5,000 right now, well, guess what? You only pay taxes on $5,000. You move it out and it has a chance to recover out there. Now, it could be subject to capital gains tax later down the road if you go to sell it. So you want to, just be strategic. It's not the end of the world to pay capital gains tax on positions. It just means simply that you've made money. So if you're sure about your income, if you may have any income surprises between now and the end of the year, you may want to wait and see what those are going to be, because you want to have a pretty good idea of what tax bracket you're going to be moving that money out in. You also want to be aware of any year-end processing deadlines that your brokerage firm has. So we recommend to our clients that they get their year-end stuff done by the first week in December, just to make sure that everything gets processed. You know, you have lots of people that take vacations during the last month of the year. You've got the holidays and all of those things. That slows down back office processes a little bit. So if you're going to wait, I would for sure get it done by first week in December.